Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is founder, chief economist, and global strategist at Euro Pacific Capital, chairman of Schiff Gold, founder of Schiff Sovereign, and host of Schiff Radio. He's also the best-selling author of How Economy Grows and Why It Crashes, a follow-up to his father, Irwin Schiff's book. Peter Schiff, thank you for joining me again.
Oh, my pleasure. Thanks for inviting me back on.
So, Peter, we're recording this interview on Tuesday, September 24th, 2024. The gold price has rallied a lot lately. It's up to $2,656. I want to get your thoughts first on the central banks in the G7. So like the European Central Bank, the Bank of England, the Federal Reserve Bank, they've all started this rate cutting cycle. Where do you think the liquidity, once the central banks continue to cut interest rates more, where do you think the liquidity, which asset markets do you think the liquidity is going to end up?
Well, clearly it's going to end up in precious metals. That's where some of it's going to go. But I think it's going to be headed to real assets. I think primarily outside the U.S. I think the dollar is in for a lot of trouble. In fact, the dollar got hammered today. It's very close to a new 14-year low against the Swiss franc. But the dollar index is getting ready to break through the 100 handle. And I think when the dollar really starts to fall, you're going to see increased upward pressure on gold. Silver was up 5% today. It's now back above $32 an ounce, but it's still ridiculously cheap. Remember, we had a $50 high going back to 1980, and then it retested it in 2011. I think maybe by next year, $50 is going to be the support for silver, not the resistance, and gold will clearly be above 3,000 by then and may even get there by the end of the year. And I think, the Fed is going to be supplying even more liquidity because I think by the first quarter of next year, they're not just going to be cutting rates. They're going to be back to doing quantitative easing.
And by quantitative easing, you mean monetizing debt to buy government bonds? You mean like creating currency out of thin air and buying government bonds with it?
Yeah, exactly. Creating inflation. Because I think what's already happening is that even though the Fed has reduced short-term rates, long-term rates have now headed back higher. And so the yield on a 10-year treasury, on a 30-year mortgage is higher today than it was before the Fed cut rates. And I think that rates are going to continue to rise. I think the 10-year is going to get above 4% before the end of the year. It's around 3.75% now. And I think that's going to put the pressure on the Fed to try to bring those rates down. And that means they have to stop selling treasuries and go back to buying them.
Now, the narrative that the Fed is saying for some of the justification for cutting the interest rates is that they have inflation tamed or beat. Do you think that they actually tamed inflation and that the consumer price index is anything close to the 2% number that they're claiming that they've tamed inflation?
No, I mean, first of all, inflation, the way the government has measured it, has been around 3% now for over a year. And so the progress has clearly stopped. Well short of 2%. But now that the Fed is cutting rates again, it's going to reverse and head higher, especially if the dollar responds to the rate cuts by dropping, which I believe it will. That will put a lot of upward pressure on commodity prices, oil, copper, other prices. And all of that is going to bleed into the headline CPI. So I think we've seen the lows and we're headed higher. We haven't seen the highs. We got to 9.25 on a year-over-year basis. I think within the next year or two, we're going to take that high out.
And they're also calling out, we have Jerome Powell, 6 months ago, calling out the people in the Bureau of Labor Statistics about phony jobs reports in the Biden administration. I mean, if they're calling out the government on the jobs reports, the consumer price index has to have issues too.
Well, yeah. I mean, they're finally acknowledging that the jobs numbers are not quite what they seem, and believe me, they're still overestimating the job creation. But yeah, I mean, unemployment too. I mean, the Fed talks about 4.2% unemployment as if we really have low unemployment. If you look at the U6 number, it's 7.9. That's the most recent number. That's a far more accurate number. That is a lot closer to the real unemployment rate. That's higher than 7.9. But you can't look at the U3 number because it's completely meaningless now because so many unemployed people are no longer counted in that number. And so it doesn't make any sense to even look at it. And in fact, when you compare the unemployment rate today to unemployment that we had in the 90s or the 80s or the 70s, it's apples to oranges because we didn't have U3 back then. We only had what we now call U6. And the unemployment rate that we have right now is actually higher than any unemployment rate we had during the 90s or the 80s or even the 70s on a year-end basis, or the 60s.
That's an excellent point. And I think in the jobs report data, aren't they also counting like people who have 2 or 3 part-time jobs? They're counting those as basically fully employed. And those numbers are going parabolic, the amount of Americans that need 2 or 3 part-time jobs or multiple full-time jobs.
Yeah, well, when it comes to the job creation numbers, it doesn't matter whether you have a full-time job or you just work an hour a week. Any work counts as being employed. And as far as job creation, if I get 3 part-time jobs, that counts as 3 jobs, not 1.5 jobs or whatever. They don't differentiate. So let's say there's 1 full-time job that's lost and 2 part-time jobs are created. The government scores that as plus 1 job. Right? Even though in reality there isn't really jobs being created, you've replaced 1 full-time job with 2 part-time jobs.
Yeah, or your income has collapsed by more than 50%. The government's not accounting for that either. So if your full-time job was like $80,000 a year and your 2 part-time jobs are 45 or 50,000, the government's not accounting for that either.
Right. Even if your 2 part-time jobs don't even add up to your old 1 full-time job, which they may not, because you may be losing your benefits. So maybe your full-time job came with health insurance and your part-time jobs don't.
The other major issue, and I've lived right outside of Washington, D.C. for almost 25 years now, is all the government spending is counted positively towards GDP growth. You have all these programs that the government, whether it's Republican or Democrat in the White House or controlling of Congress, this particular administration, what they had, the Inflation Reduction Act. Do you think it actually reduced inflation if they're spending like enormous budget deficits? It seems like there's trillions of waste, fraud, corruption, and abuse, and that created even more inflation.
Yeah, I mean, look, the Inflation Reduction Act, like all government acts, the name is the opposite of what it actually achieves. And so the Inflation Reduction Act was actually an act to increase inflation, which is in fact what it's done, because the Inflation Reduction Act was about government increasing spending. And that's the source of the inflation. You know, the government is spending money it doesn't have, and it's increasing aggregate demand and ultimately causing the Fed to have to print more money. So if we really wanted to reduce inflation, we would have to cut government spending, not increase government spending. But that's what the Biden administration did.
And there's perverse incentives too, right? Because the government spending more, that's counted positively towards nominal GDP growth, because the government's not differentiating between what government spending, private sector spending, consumer spending, and investment. That's the Keynesian cross. So all those things are counted equally in the GDP calculation.
Yeah. And again, GDP is another one of those government measures that doesn't really tell the real story. I mean, look at our current account deficits. We have the worst current account deficits in history, horrible, the worst trade deficits, and government tax revenue has plunged. All of that would indicate that the economy is weak. We're not strong enough to produce goods. We're not strong enough to produce tax revenue. And we're having these record deficits, budget deficits too, because of the underlying weakness of the economy. And in fact, so many people are working multiple jobs, not because the economy is strong, but because it's weak. People don't want to work 2 or 3 jobs. They want to work 1 job, but 1 job won't cut it anymore because the salary is not high enough to pay the rent or put food on the table. So people have to work multiple jobs, and they have to give up their evenings. They have to give up their weekends and work harder.
Yeah, and so the real economy then has stagflation and shrinkflation way above the consumer price index, because I think the consumer price index is claiming that rents aren't going up, that a lot of other everyday necessities for Americans are not going up, and in the reality of people's bills is the opposite.
Mm-hmm. Yeah, and in fact, the big reason I think that the inflation numbers came down is we had a big drop in used car prices. But used car prices went way up, so they corrected. But it's not like people are buying new used cars, every month or even every year. So the fact that a used car price has come down is not that relevant to most people who are not buying a used car this year. In fact, it may be relevant if you're trying to sell your car because you need the money, and now you're going to get less.
Now, I want to ask you about Austrian school economics and the strength of the banking system. You used to give speeches in 2005, 6, and 7 about the housing crisis. And you would argue against what people from the Harvard pension fund saying that the housing prices would collapse. How would you rate the strength of the banking system right now based on all the government spending and the shenanigans, the policy moves the Fed has done?
Well, I think the banking system is in worse shape today than it was just before the '08 financial crisis. And because back then the problem with the banks was the real estate loans that were in default because they extended credit too recklessly. They let people buy with no money down and adjustable rate mortgages, teaser rates, and uh, borrowers were only willing to stretch to make those payments because they thought they were going to get rich owning a house. But once the real estate prices started to fall, it didn't make any sense for people to struggle to make mortgage payments when they had no equity in the home and they could just go rent something for less money. And so a lot of people were mailing in their keys, and the banks were in trouble because when they went to foreclose and sell the houses, they couldn't get enough money to cover what they loaned out. So the banks basically went insolvent because those losses blew up their capital. But right now, it's much worse. I think the banking system is completely insolvent because it's a bigger mortgage problem now than it was before. Because back then in '08, the problem was the mortgages that didn't pay. Today, the problem is all the mortgages, including the people who are making their payments, because the value of those mortgages has crashed, not the value of the collateral, but the value of the mortgage, because now they're collecting 3%, 4% mortgages, but they're paying the Fed 5% for the money. So, when they had a 3% mortgage and 0% interest rates, those were profitable loans. Those loans are now unprofitable. So the banks are getting killed. In addition, the banks are getting destroyed on their commercial loan portfolio, which wasn't even a problem in 2008. Commercial real estate didn't go down. There were no losses. Now there's horrific losses across the board. Commercial real estate prices have gone down 30, 40, 50%. And a lot of these loans are going into default. And so there's a huge loss there. So I think the banking system is in worse shape than it was back then. I think the losses that are being hidden are bigger. That's the real reason the Fed stopped hiking rates. It was when Silicon Valley Bank and Signature Bank and these banks started to fail. That's what stopped the rate hikes. It wasn't because the Fed won the battle against inflation. It's because the war caused too much collateral damage in the financial system. And so they stopped hiking prematurely. We never actually got rates into restrictive territory. That's why, the debts never came down. That's why we have record high household debt, record high credit card debt, record high government debt, because rates never got high enough to stop the borrowing or to encourage savings, which is why we have a record low savings rate. And, in order to bring inflation down, you have to bring savings up. And the Fed didn't accomplish that.
Well, one of the main goals of the Fed, the actual goals, is for the Fed to bail out the banks when they get into trouble. It seems since 2008, the rules are constantly changing for bank bailouts to save these big banks, whether it's during the 2008 financial crisis, or it's Credit Suisse in the last couple of years, that Japanese bank in the last couple months. So all these rules can be changed. In 2008, the Fed had to, part of the quantitative easing program, they had to buy trillions of dollars of mortgage-backed securities. They had to give BlackRock and other hedge funds, private equity, those types, like enormous loans to go and buy all those homes to try to drive real estate prices up over the course of a couple of years. So look at all the rules changes and bailouts done there.
The housing sector, I think, or the banks rather, are stuck with these underwater mortgages and underwater treasuries. I mean, for years and years, people were, singing the praises of the Fed's actions to lower rates because it was allowing homeowners to refinance all their mortgages and to get a better balance sheet because now their mortgage was a lot less expensive, and that freed up cash for, other things. But I kept focusing on what that was doing to the lenders, because the lenders ultimately were going to be stuck with these mortgages when rates rose. And so what the borrower gained, the lender lost. And these lender losses is why our whole financial system is insolvent. And of course, the US government stands behind that insolvent financial system because all these government bank accounts are government guaranteed. But, the government doesn't have any money. So the Fed has to print the money.
If you read Murray Rothbard of Austrian School of Economics with fractional reserve banking, I mean, like they can lower the reserve ratios. In 2008 with Citibank, didn't they lower it down to zero? So Citibank was levered at 1.100 to 1. But fractional reserve banking, the banks are almost all constantly insolvent. It's the Fed that protects them from all going insolvent at the same time.
Well, yes. I mean, obviously, if we didn't have the government backstops, the banks could not have this, thin level of capital. The free market would force banks to keep a lot more capital. Otherwise, there'd be runs and the banks would fail. It's only because the public perceives the government's guaranteeing all their deposits that banks are able to run up such high levels of debt. So, that's the moral hazard, and that is how everything has backfired. The government tried to guarantee the bank deposits to make the banking system safer, but it ended up making it inherently much riskier by removing all the incentives to have safe banks, because the public doesn't care how risky their bank is because the government's guaranteeing it. And so since the customers don't care about risk, neither do the banks. Banks don't compete with each other over who's got the least risky bank because nobody cares about that. So the government has destroyed the entire free market system that would have produced a solvent banking system. And we have a completely insolvent system that is propped up by a bankrupt government. Right? The government is broke and it's propping up a banking system that's broke.
Yeah, I agree. And without what all those new programs with the BTFP raising the FDIC limits, I mean, Silicon Valley Bank would have triggered a bunch of other bank runs in short order.
Oh yeah, I mean, and interestingly enough, if you think about the banking system in the 1930s, during the Great Depression, when there was no insured bank deposits at all, only about 2% of all the deposits were lost during the entire decade of the 1930s. So, the banking system was very sound, and even though some banks failed, the vast majority of banks did not fail. They made it through the Depression. But today, pretty much all the banks would fail that because of the government safety nets that they've all relied on instead of relying on their own solvency.
And every crisis, it seems that the central banks, whether it's the People's Bank of China, the European Central Bank, the Federal Reserve Bank, in a crisis, they lower the reserve ratio requirements for the banks to try to make them appear more solvent too, when a lot of them are close to insolvency as well. All the rules changes and the bailouts and the goalposts moving. This is like the new normal post 2008.
Yeah, and the stress tests that they routinely reveal are all bogus too, because they never stress for what's actually going to happen, which is a situation where the economy is in recession, but interest rates go up. That they've never once tested for that because they assume it's impossible.
Now, I want to ask you about the M2 money supply growth. Most economists say that that's inflationary. It looks like the banks are not loaning into the real economy, though. Where do you think the loans are actually going? Are they going to the government to buy treasuries?
Well, of course, I mean, a lot of money is going to the government because somebody's buying those treasuries. We're running deficits of 3 to 4 trillion a year. So clearly, somebody's buying those treasuries because that's the only way the Fed can sell them. So a lot of the inflation is going through the government. Of course, the government takes that money that it gets by selling treasuries and mails out Social Security checks, mails out government pension checks, pays the salaries of the soldiers. So, all that money that's getting borrowed by the government is getting spent by whoever receives the government check. And so all that is bidding up prices.
Okay, so you have the commercial banking system is the one with the M2 money supply growth that most economists say is inflationary. They're the ones that are buying the U.S. Treasuries with their money supply growth in the commercial banking system by loans. They're not loaning into the real economy. Meanwhile, on the other hand, what you said earlier with the central bank liquidity, all these central banks starting to lower rates and add liquidity to the system, they're not buying U.S. Treasuries. It looks to me the last 2 years, Peter, that they've decided each month they want to buy more gold tonnage and not buy Treasuries.
Yeah, I mean, that's where all the demand for gold has been coming from. Americans have been net sellers of gold all year. There's been net withdrawals from the gold ETFs. The same thing with gold stock indexes. The GDX, GDXJ have had net redemptions all year where Americans have been selling gold and selling gold mining stocks, even though gold is on track for its best year since 1979. I mean, that's amazing. It's like the best year for gold in 45 years, and nobody in America or hardly anybody is buying any gold. and the people that own gold have been selling it. So, they're missing out on this big gain. And, unlike 1979, that was the last year of the gold bull market because it stopped in 1980 because the Fed raised rates to 20%. Well, the Fed's going to cut rates in 2025. So this is not the end of the bull market. This is just the beginning.
And I doubt those dot plot projections are going to be accurate. I mean, like, if any of the banks start to fail, the Fed's going to panic and start to cut rates even faster than their projections on the dot plots.
Again, yeah, but the bigger thing is the return to QE. And remember, when the banks started to fail before, the Fed did like 300 billion in QE in 1 week. That was when, Signature Valley Bank failed. So that's going to happen. That whole thing is going to get restarted.
But to your point, though, about gold, I mean, I watch business TV a couple hours a day, Fox Business, CNBC, Bloomberg. I scroll through it. I don't see them, despite the gold price rallying enormously. They don't talk about gold. They don't bring any experts on to talk about gold. It's almost all what tech stocks or Bitcoin or whatever technology industry is doing well because they want people to trade a lot or stock options.
Yeah, I mean, that's what the financial networks, CNBC in particular, they're the biggest advertisers on CNBC are crypto companies. And so they want to keep promoting crypto. So the advertisers keep buying the commercials. And they also make sure that their content is really an infomercial in disguise. So in order to placate their crypto advertisers, they constantly bring on pro Bitcoin and crypto guests. And they don't invite people on who are anti Bitcoin and crypto. They also really don't invite people to talk about gold or inflation or the Fed unless they're spinning it as a pro Bitcoin. And in fact, whenever they talk about gold, they say, well, what about digital gold? They've just completely accepted the false narrative from the Bitcoin community that Bitcoin is digital gold when it's not digital gold at all. I mean, Bitcoin is no more digital gold than a photograph of a hamburger is digital food. Just because I draw something and make it look like gold, and even if I tokenize it, that doesn't mean that it's gold. It's not. There's no use for gold where you can substitute Bitcoin, and so it's just a digital blockchain letter. That's all it is. But the media is all behind it because they're getting all the ad spending. But where are the crypto companies getting all this money to buy ads? They're getting it because people are dumb enough to buy Bitcoin and they're selling theirs, and they're getting the money they get selling Bitcoin, and some of it goes into taking out ads so they can sell more Bitcoin. But these guys bought all their Bitcoin years ago when the price was a lot cheaper, and now they're getting rid of it with the help of the media at a much higher price. But people forget Bitcoin, even though it's 63,000, 64,000. It was at 69,000 was the high 3 years ago. So where has it gone? It's basically just gone sideways for 3 years of massive pumping. You've had, all of the commercials, the Super Bowl commercials, massive conferences, 20,000 people at the last one in Nashville, 10 Bitcoin ETFs, Ethereum ETFs, Michael Saylor buying 10 billion worth of Bitcoin with borrowed money off the balance sheet of the company. You've had El Salvador use taxpayer money to buy Bitcoin. And now you have presidential candidates promising to use American taxpayer money to buy Bitcoin. All of this, and yet, and the price can't go up. And in fact, in gold terms, Bitcoin is more than 30% cheaper relative to gold than it was 3 years ago at its peak. And so nobody is talking about that. Everybody dismisses that. They just focus on, well, Bitcoin used to be $1 and now it's 64,000. So it's the greatest investment of all time.
I didn't know that the Bitcoin people spend the most on ads. I thought it was like the mutual fund companies or the banks for like the index funds. So like BlackRock or JP Morgan Wealth Management or those guys.
Well, BlackRock now, they have a Bitcoin ETF. But no, when I watch it, I see Grayscale. I would say Grayscale is the biggest advertiser on CNBC. But there are other, but they sponsor like Crypto Moment, Crypto Minute. I mean, there's all kinds of sponsored crypto updates. I'd say it's the crypto ads have got to be number one, more than any other company, just based on, I'd say every time there's a commercial break on CNBC, there's at least one ad for a crypto.
That's interesting. Guess they've replaced stock options and Viagra then.
Yeah.
Just had to throw some jokes in there, sad but true. I mean, like on Fox Business, I watch that. You should be on there too, by the way. I mean, like
Well,
experts too.
Fox Business does have me on. I go on Liz Clayman's show. I was just on last week. I go on Charles Payne's show. So there's a couple of people there, but I haven't been on CNBC in over 7 years. And it's interesting. The last appearance I ever had on CNBC was on Fast Money in 2017 in February, and I had a Bitcoin debate. I was Bitcoin gold debate, and two of the people said I won. Two of the Fast Money crew, and one said I think I like Bitcoin, and the other two said I'm with Schiff. I like gold. That was the last time I was ever on CNBC. So it may not be a coincidence that my last appearance on the network was a Bitcoin debate, because maybe the Bitcoin advertisers didn't want me on, and they said, "Look, we'll advertise on CNBC, but you can't have Schiff on, criticizing Bitcoin when we're trying to run these Bitcoin ads." So, I mean, I don't know for sure, but I mean, why? I mean, they just completely banned me from their network, and I used to be on a lot. And so what's the other reason? I mean, what else happened? That would explain it. I mean, I don't know, because they don't tell you, but I don't think it's a coincidence that the last thing I did on CNBC was a Bitcoin debate where I was anti-Bitcoin.
And if I remember correctly, that's around when the gold price bottomed to around 1500, when that was the depths of the bear market. And then within 18 months, there was a pretty substantial rally.
Yeah, I mean, although Bitcoin was really cheap back then, I mean, Bitcoin was, I think, under 2,000, in early 2017. So it had that big run up to 20,000 and pulled back, and then it went to 60,000. But, I never came on again. And, when I was on that show, they kept saying, "Hey, this was a great debate. We should do a whole bunch of them." They talked about the Lincoln Douglas debates. They said, "Yeah, they had like 7. We should make this a regular feature on our show." And that was the last time I was on. But of course, Brian Kelly, he's the guy that I was debating. He's on constantly, right? He was the big Bitcoin pumper that basically convinced everybody else. Now the whole network is pretty much all in on Bitcoin.
Do you think that this is intentional to what start accelerating the process towards central bank digital currency, that there's like intentional policy for like marketing, media promotion, the government, central banks, mainstream financial media, the large banks, BlackRock are all involved in this?
Yeah, I mean, well, I think the big banks got involved because they saw that they could get demand and they could generate fees. And now the big banks are making a lot of money on these, worthless Bitcoin ETFs that they have. And so now all of a sudden they love Bitcoin because they can make a buck off of it, right? That's all that's changed. I mean, they just basically sold out. They don't give a damn how much money their customers lose, just so long as they can collect fees. But yeah, I think what will happen when Bitcoin ultimately collapses, the government will say, "Yes, you see, capitalism doesn't work. You can't trust the free market, or you can't trust businesses. But we do like the idea. We just need the government to do it." So Bitcoin didn't work because it was a creature created by greedy capitalists who ripped you off. Now the government's going to do it right. We're going to have a central bank digital currency that everybody can trust, right? And so, yeah, they may well use the demise of Bitcoin and all the losses as a way to argue for a government digital currency, and then to ban all the other ones.
Now, as we wrap up here, I want to ask you about deflation. Do you think that capitalism and free markets produce beneficial deflation, and that the government hates deflation?
Yeah, well, the government, of course, doesn't like deflation because the government is the world's biggest debtor. And so deflation makes their debts harder to repay. Inflation is a transfer of wealth from creditors to debtors. So if you're in debt, you benefit from high inflation that wipes out your debt. And so the US government is the world's biggest debtor. And so it has the most to gain from inflation, which is one of the reasons that it creates it. It has other reasons for creating inflation. But that's why it redefined inflation. So because it doesn't want the public to know that it's causing inflation. Inflation is just another tax. And so when Obama ran for in 2020 and said, "I'm not going to tax people who make under 400,000," he meant I'm not going to tax them with the income tax or a payroll tax. I'm going to tax them with inflation. I'm just going to print a bunch of money, and so the price of everything they buy is going to go way up, and that extra price is just a tax.
Well, I would say the other countries, the other central banks, other people are voting, voting with their fiat currencies and their US dollars, and they're not buying US treasuries. They're buying physical gold tonnage instead. I think that seems to be one of the major themes the last 2 years.
Yeah, I mean, and that's going to continue, and it probably accelerated with the sanctions on Russia, which created a powerful political incentive to divest of dollars, so as not to be vulnerable to U.S. sanctions. But there's always been an economic argument to get rid of dollars, so that just accelerated the trend, and that's what's going on. And I think it's going to really accelerate in 2025.
Now the gold stocks, the gold producers, are only up, what, 20%, most of them. Do you think that we're headed towards one of the all-time greatest bull markets for gold mining companies?
Yeah, I think the stage is set for that. I think these stocks are incredibly cheap. You've got the major stocks like the Barracks and the Newmonts trading at substantial discounts to the S&P 500 on a PE basis, when historically they trade at premiums, and their earnings are about to explode. Whereas I think the S&P could see our earnings declines. The gold stocks, I mean, oil has never been this cheap in terms of gold. So it's never been cheaper on an energy basis to get gold out of the ground based on the price of gold and the price of oil. And so I think these gold stocks are going to be extremely competitive and efficient, and they're going to be raising their dividends. And I think after years of earnings disappointments, because the gold price didn't rise fast enough to keep up with the higher cost of mining, now we're going to see the price of gold outstripping the cost of mining. And so these companies are going to keep surprising Wall Street by beating their earnings estimates and increasing their dividends. There's going to be a huge amount of money coming into this sector. I mean, right now there's like no money in it, and the whole sector. I mean, if you added up all of the publicly traded gold stocks in the world, you wouldn't even get the market cap of a decent S&P 500 stock.
And there's a good amount of gold miners with $1,000 an ounce profit margins in free cash flow. So that's a record amount for a lot of them.
Yeah, I mean, I would be buying them like crazy if I didn't already own so much. Now, and I bought a lot myself earlier this year. When Barrick and Newmont got downgraded and hit multi-year lows earlier this year, I bought even more. I mean, I thought I was fully invested because I had been buying so much. But then it was such a gift. I was like, screw it, I'm just going to buy more, and I did, and I should have even bought more than I did, but I already was so overweight. I have half or better than half of my portfolio, my personal portfolio is in gold mining stocks, so I'm already like pretty heavy in there.
Do you have a gold mining stock ETF for people?
Well, we have a fund. I mean, better than an ETF where you just buy everything. I think if you buy my fund, you're going to get a much better allocation and get professional management. So it's the Euro Pacific Gold Fund, and you could buy that no load at any discount brokerage firm. The no load symbol on it is EPGIX. It's the Investment Managers Euro Pacific Gold Fund. It's managed by Adrian Day. And it was up 2.5% today. This price is 11.82. But it's up year to date. I'd say a little less than the price of gold. I mean, it should be up double the price of gold, really, but it's barely up as much as the price of gold. I mean, it's up a little under 30% on the year. But I mean, I think it could double or triple next year. I mean, that's my opinion. But if gold does what I think it's going to do, these stocks have to catch up. And we've got a great, portfolio of the smaller stocks, the junior miners. So those are the ones that are really going to kick in. So, yeah, I mean, obviously it's more speculative when you're buying companies. I mean, gold mining is a very risky business. There's a lot of things that can go wrong. So I think gold is very safe as something to own. I think the volatility is lower than stocks, and over time, it holds its value. Gold companies, some of them go bankrupt, so over time they lose all their value. So it's a lot riskier. But I do think that based on where they're priced right now, and how much I think gold is going to go up, and the fact that the market has no clue that this is about to happen, I think this is a bigger asymmetrical bet than the subprime short was, which is something else I was involved in. But I think there's more upside here.
I was going to ask you if institutional investors, other than maybe Stanley Druckenmiller, and generalist money managers are starting to allocate more towards gold stocks yet.
No, they're not at all. Because I mean, gold stocks have performed so poorly that they're not doing it. I mean, most people don't even have gold, let alone the stocks. And I think a lot of people have been distracted by Bitcoin. So some people think, well, why should we buy gold when there's Bitcoin, which is the new gold, digital gold? And even though they're not buying Bitcoin, they're not buying gold either. Some are buying Bitcoin. Think about all that money that came into these Bitcoin ETFs. What did it come out of? It came out of gold ETFs. It came out of gold stocks. That's where I think a lot of the money came from. Now, some of it came out of tech stocks and stuff like that, but some of it came from gold and gold stocks. So, no, I think at some point there's going to be a move, but I think it's probably going to take a bigger break in tech, because as long as, the Mag 7 stocks are going up, then why should they buy gold stocks? So, what the hell? I'll just buy tech stocks and they're going up too. So I think what's going to happen to get the institutions interested in the gold mining stock is that the tech trade has to break. And so those stocks don't have to necessarily get killed. They just have to stop going up. And if the only thing moving are the mining stocks and gold, then eventually they're going to pop on the radar of the hedge funds and the institutional investors, and then they're going to start buying.
We're fundamental driven stuff with each quarter, right? And there's good profit margins and free cash flow. So the miners, then the management team stay disciplined. They don't do bad acquisitions. They don't start throwing in the worst grade ore and destroy the profit margins. So as long as the businesses themselves continue to produce good profit margins and free cash flow, if the market doesn't recognize the valuation, but the management team keeps chugging along each quarter, producing good profit margins and free cash flow, there will be a re-rating, I suspect.
Yeah, and what's going to happen too is more consolidation, because these big companies are going to have so much money from selling gold that they're going to be able to buy up the smaller companies to get their reserves, to get that extra gold, because it's going to be a lot cheaper to go buy more reserves on Wall Street than mine for it. Because exploration is a very expensive thing to do. It's much easier to just buy out a company when it has proven reserves. You could just buy the companies because a lot of these small stocks are just ridiculously cheap.
Exactly. We've seen two deals lately where a Cisco Mining was taken out by Goldfields, and Anglo Gold Ashanti just made acquisition the last couple of weeks. Well, I want to thank you so much for your time today, Peter. I really enjoyed this discussion. If my listeners want to check out the Peter Schiff Show or your books, how do they do so?
Yeah, and first, just to comment, every time those acquisitions happen, the acquiring company stock gets hammered. And in fact, the market has punished all these gold stocks. Any news has been bad news. Even if they beat earnings, it's not as big a benefit as a miss. They miss by a couple of cents because of some one-off event, and they take the stock, out behind the barn and shoot it. So that's a symptom of a bear market, and that's these stocks have been in a bear market, even though gold has been in a bull market. It's like you can buy gold at a record high and still be a contrarian because nobody believes the rally. That's why they're not buying the miners, because they're looking beyond the rally to the next gold crash, and so people are reluctant to buy the gold mining stocks because they don't believe the rally in gold is real. Well, at some point, they're going to have to believe. But anyway, if people want to get a hold of me, I'm out there. Listen to my podcast, the Peter Schiff Show podcast. You can listen on Schiff Radio. If you want to see me, go to my YouTube channel, because we do it live on YouTube. And there's video on my YouTube channel. You can also listen anywhere they have podcasts on all these various iTunes, Spotify. My podcast is there. Also, follow me on X. I'm constantly posting. I have over 1 million followers now, so I've got a pretty good soapbox to tell the truth, and I do all my own posts. So you should follow me there. I'm also on Instagram, Facebook, TikTok. So just look around on all your favorite social media apps for me, and you can join the following and help me spread the word. I have a new company, Schiff Sovereign, where we put out a free newsletter. Comes out several times a week. It's very well written. A lot of important information that the mainstream media doesn't cover. You can just go to schiffsovereign.com and give us your email address so you can get the free newsletter there. But most importantly, you got to protect your wealth. You got to get rid of fiat currencies, buy gold and silver. Shift Gold now has an online platform. You can, go fill up a shopping cart, check out. You can buy 24/7 at shiftgold.com. You can buy gold and silver bullion. I would encourage people to buy sooner rather than later. The sooner you buy, the cheaper it's going to be. And if you have a more significant portfolio that you've got retirement accounts, you should really contact my team at Euro Pacific Asset Management. Europac.com is the URL, EUROPAC.com. We manage portfolios, separately managed accounts. I also manage my mutual fund family. We have wrap programs where I can manage your account in the mutual funds. But if you want to do it yourself, you could just, if you have Schwab or Fidelity or TD or International Broker, any of these big discount brokerage firms, all my mutual funds are there. You just got to go buy them. There's a no load and a load version. So, if you're doing it yourself, avoid the load and buy the no load. Again, for the gold fund, it's EPGIX. And that's the no load Euro Pacific Gold Fund. I would buy that, tomorrow. Obviously, you can't buy it today. The market's closed. But if you don't have gold stocks, you need to buy them as long as you can take the risk, right? Don't put money in gold stocks that you can't afford to lose. But I think the upside potential just dwarfs the downside risk. That's why I want all these crypto guys. I mean, there's so much more upside potential in gold stocks than there is in Bitcoin, and there's even less downside risk. I think Bitcoin can go to zero. A diversified basket of gold mining stocks isn't going to zero. I mean, it could lose half its value, but it's not going to zero. On the other hand, it can go up 10x. It can go up 20x. I don't think there's any chance that Bitcoin can do that. Maybe Bitcoin can double from here, maybe triple. I doubt it, but that would be about it if it can even do that. Whereas you have a lot more potential in these mining stocks.